Today on the show, we are doing an economic update. We are recording this on Thursday, the 18th of June. We're starting about 11:15 a.m. And I'm joined by Gemma Dale from nabtrade. Welcome to Money, Money, Money.
Thank you for having me.
Now, what we're going to try and do is we'll talk about the SpaceX IPO, we'll talk about the market update, and look, we're going to have a lot of fun in between. If you find this episode useful, let us know in the comments. If you want us to do more of these, maybe get Gemma into a monthly update. I don't know, it could be fun. But primarily it will help if you're watching it on YouTube, but if you are driving or ploughing with your tractor and you got your headphones in, you'll get the gist of everything because we've got some charts and all that. But thank you so much for listening. Let's get into it right now. Before we get into it, this show is general advice only. I've got a license to provide that advice. Full details can be found in the show description. My name's Glen James, former financial advisor. I host this show and a show called Retire Right. I've got some books, the award-winning Quick Start Guide to Investing and the Quick Start Guide to Your First Property, available where good books are sold or in the description. If you're new here, welcome. If you're an old hand, welcome to M3. Let's get into it right now. Okay, Gem, we have launched. We've gone, let's get off this planet and launch out of here.
Data centers on Mars.
Yeah, so SpaceX IPO'd. What, I don't know, I've got a lot to say about it.
Yeah.
At the time of recording, the share price is up about 40%.
Yeah.
It's a lot of money.
Yeah. World's first trillionaire.
Yeah. They say the first trillion's the hardest though.
It's been the hardest for all of us. I mean, we've really struggled to get there.
Yeah. I've got heaps of thoughts. Talk to us. What are you hearing out there? And there's a question here that we'll ask. Maybe I'll read it now because we'll swing back to it. Chantarella in our group said, "Hi, is anyone concerned about these IPOs that industry super funds will be forced to invest in, like SpaceX, OpenAI, Anthropic, and their overinflated valuation risks? How do you opt out as an industry super member?" So we'll talk about that.
Yes.
But over to you. What are your thoughts? Opinion piece.
Look, it's an incredible one, and it is one that we also get a lot of questions about from investors leading up to the IPO. Can I get an allocation? I want exposure, or the flip side of it, exactly what Chantarella was asking, which is I don't want an allocation to this. And the reason that people were concerned about not wanting an allocation, generally, if something IPOs and you don't like it, that's cool. Just don't buy it, right? Just don't participate in the capital raise and don't participate on market. Just don't buy it. You're good. But with SpaceX, what has occurred is that NASDAQ in particular, but also FTSE Russell and also MSCI have reviewed their index rules. So when you buy an index fund, now it's an ETF, right? Used to be an index fund if you were around a long time ago. When you buy an ETF that tracks an index, generally speaking, they've got a whole lot of strict rules about when a company can or won't be included. Tesla's the classic example. Tesla was a top 10 company by market cap and was not in the S&P 500. And the reason it wasn't in the S&P 500 is it didn't meet the profitability requirements, and that's only one of the 3 requirements it had to meet. So there's a free float requirement, which is basically how much of the company is available on market versus how much is held by private investors. SpaceX, very little is available to the public market, even though it's the biggest IPO.
About 4.3%
there you go.
of SpaceX is listed.
Yeah. Teeny tiny, right, relative to the amount that's still held by earlier investors. So there's a free float requirement. There's a profitability requirement. And that profitability requirement, Tesla just did not meet. It was unprofitable for a long time. And then it finally got across the line. And there's also the amount of time it has been listed, so generally 12 months. Tesla finally got there and went into the top 10, which was pretty crazy, right? It was enormous and trading on 300 times PE at the time. By the time it made it into the S&P 500, There are so many implications from that. Part of it is there's a huge run-up before it's included in the index because everybody goes, once you're in the index, you get all the passive flows. And the passive flows we now know are an enormous proportion of the market. So that is just free money, free capital, happy days. I would like to be part of that. What has happened with SpaceX is that most of the major index providers have had a look at their rules and gone, would we consider changing them a little bit now that we've got these massive guys coming to market? This might be a time for us to review our rules. The only one that declined to change them that is a major one was S&P. So the S&P 500, you still have to be listed for 365 days.
I respect that.
Yeah.
All day long.
Yep. Fair call.
Yeah.
You had the same rules for everybody. If we just did not provide an adequate free float and we don't meet the profitability requirements, why should we shorten the seasoning period? I mean, that's probably the first question. So S&P said no. NASDAQ, however, 15 days now, and let's not worry about profitability. That's not important anymore. So 15 days. That may explain a reasonable amount of the 40% uplift, right?
But this is where it comes to, is it obviously we've got the NASDAQ, and if in the US, if you want to buy the ETF QQQ, right, which is the index of the NASDAQ, top 100 companies, usually on the NASDAQ, it's tech companies.
Yep.
And there's a bit of history there. I don't know if we should bore people, but traditionally there was less paperwork and it was just more digital. If you're a tech company, list on this exchange, it's easier, blah, blah, blah.
Yeah.
Yeah, you've just got to wonder about the commercials, and I saw some commenters like, all right, we're changing these rules now just for these big whales. Like, is there a bit more active management of the index now? I don't know. That's why I respect the S&P 500 by going, no, that's our rules.
Yeah.
This is our index.
And
call
also,
us old-fashioned, whatever.
Yeah, and it's worth noting the NASDAQ is an exchange. The index is a different thing.
Yes.
It's not everybody on the exchange is in the NASDAQ 100, obviously. So FTSE Russell, though, so the Russell did change and MSCI changed.
Yeah.
But MSCI, they have still got a free, so they allocate according to the free float, not the total market cap, and that's actually terribly important. So when you look back to the question from Chantarella, though, because this is why it's irrelevant to you. As I said, the average person did not need to care if they didn't like a stock in the past. They're like, I don't like that IPO. I shall just not participate. It is not relevant to me. Now you need to care if it is going to go into an index that either your fund invests in, because a lot of funds are passive now. A lot of super funds have either in-sourced, so they run their own money, or instead of allocating to an external manager, or they just have index exposure. Or is benchmark too. And the benchmark's really important. So if you are a fund manager and your benchmark is MSCI World or is the S&P 500, you don't want to not have exposure to something that can go to the moon, no pun intended, because you may get left behind. And if your performance is awful, then no one's going to invest with you. You might lose your mandates and so on. So it creates risk even if your fund is not actually an index fund. Even if they are active. Active managers have to keep an eye on the benchmark that they are benchmarked to. I'm repeating myself. But, if the benchmark is relevant for your fund manager, then you have to think about it as well. So for a lot of people, suddenly this is really important, unless you've explicitly chosen to have the S&P 500 in your fund, in which case you're good.
Yeah. So I use IVV in my portfolio.
There you go.
And so I don't have a slice of SpaceX. So we need to know that SpaceX, it's this huge company. It's broadly Starlink, which is the one that's making the money.
Yeah.
The shuttle services and getting stuff into space ain't doing too good. And the AI stuff's taking a big bath as well, like your Grok and all that. So it's a huge company. I'm personally not rushing out, and I didn't want to rush out and get in a pre-IPO and get an offer. It was well and truly oversubscribed. So there's a hype factor.
Yeah.
I'm very interested, and I'm happy to always wipe my face because there's always egg on it. But what's going to happen when these institutional dogs that got in there, when they can sell out? Like, is it a smash and grab? Because as the questioner said, night and day, the numbers say this thing's overvalued, it's not making money, but we do buy companies for the future value as well. I don't know.
The last couple of decades have been fascinating on that basis. Actually, we're going to talk later about what's happened in markets. Profitless growth was the trade for a decade or more coming out of the GFC, right? That was where you wanted to be. You wanted to be in the hyperscalers that started off with straight up profitless growth, right?
Yeah.
That's what they were doing. Capital was very cheap. You plowed it into...
It's capital and it's capitalism, baby.
You just plowed your money into positive jaws at one point, but they started off the other way around, right? Negative jaws. Your expenses were growing. That was fine because your customer base was growing and growing and growing and growing, and at some point you were going to start charging them a reasonable amount of money, but you had such extraordinary market share and you were so deeply embedded in corporates and individuals' lives that you were going to become profitable. Tesla's the interesting one, right? It's a car business, and all of the promised technology that was going to make it the most valuable car company on earth. It's still trading on quite an extraordinary PE relative to most other companies, let alone other car companies. So people buy Elon and they believe that he can deliver frankly extraordinary share price performance.
Yeah.
He delivers share price performance. Does he deliver incredible company performance? That's a different question. But the share prices, they're fabulous if you happen to be on board at the right time.
Yeah. So it was I love the funness when he does all this stuff. Like the Tesla car models, it was S, 3, X and Y, sexy. The amount of shares they opened for IPO was like 550 million, 550,000, or billion or whatever. It was all fives. That was the shares on offer. So the MSCI, which is the Morgan Stanley Capital International Index, World Index ex Australia. So, and this is important. So if someone buys, say, VGS in Australia, they're going to get part of the SpaceX the minute it's included. It could be around what percentage? About 1%.
So if you're going MSCI, it was originally going to be like 0.6%.
Yeah.
Obviously, as the share price appreciates, your allocation increases, right? So it's worth noting because the share price has appreciated very rapidly, then you are going to get a little bit more. That's an interesting position to be in.
Yeah.
MSCI's more meaningful to most investors, frankly, than the S&P 500, even though the S&P 500. The reason I mention S&P, when I look at what our guys are doing, so on nabtrade, it's been fascinating to see the growth of ETFs, and that is a lot of self-managed super funds as well as individuals. So this is your retirement savings for a lot of people. What they buy is consistent, and it is the ASX 200. So they go domestic first with an ETF every day of the week.
So that would mainly be VAS, wouldn't
Yep,
it?
100%. And for whatever
peeps?
reason, it's Vanguard. I don't know why it's Vanguard, but it always is. Daylight, and then they go S&P 500. They do not go MSCI World or anything sort of more broad. They go S&P 500 specifically. They want US exposure. Then they might go NASDAQ or something more niche. I get asked a lot about niche ETFs. So people are buying battery tech or they're buying this. That, it depends on whatever's hot on the day. The only one we've seen in the sort of more niche space is gold. There has absolutely been increasing allocation to gold for about 2 years, and people pick up a sleeve of that and put it in their portfolio. But it's ASX 200, S&P 500, and then a smattering of other things.
Yeah, bit of CBA in there, I'm sure.
Oh, this is just the ETF side.
Oh, just the ETF side, yeah.
If we're talking to like direct stocks, a different story entirely. Yeah. But when
does nabtrade publish their main like direct stock?
Yeah, top
holding?
5 sort of thing all the time. Yeah, absolutely. And I talk about it all the time. So it's not proprietary information, and that we worry about people finding out these special insider things that people are doing. It's all on market. What has been most interesting, though, is I was asked about ETFs, 7, 8 years ago. Oh, ETFs are growing so fast, people buying them. And I was always like, look, sure. but they're 4% of turnover,
Yeah.
right? They're tiny. They're now closer to 16% of the book and the turnover. And when you look at what is occurring, it is mostly new people coming to market. And by new, I mean anyone who's come either during or post-COVID. Those investors, and particularly the under 40s, it's like 40% of their portfolio is only ETFs. So ETFs have just become the core holding for newer investors. They've gone, I can't be bothered to take stock-specific risk. I'm only going to do that at the margin of my portfolio. I just want to build wealth, and that's my strategy to do it.
Yeah.
And it is a huge proportion of what we have now.
Yeah, I mean, the whole SpaceX thing, so the questioner is like, is it in my super fund? I don't want to be.
Yeah.
We need to go back, as you said, to the portfolio rules. You're a member of your super fund.
Yes.
Go to their website, call them. What you
Yeah.
need to know the philosophy and the investment rules for international equities.
Yeah.
And that will tell you.
Well, first of all, what's your allocation, right?
Yes.
Are you 70% US, which is roughly the benchmark allocation at the moment, which is wild in itself? And then what benchmark are they using? Are they just picking sleeves for individual countries, or are they benchmarking and they're using a sort of an overall portfolio approach?
Yeah.
There's so many different ways it can be done, and you need to know which one your fund is using, and do they index? Is it all passive?
Yeah.
Is a lot of it active? What are the active guys doing? It's a lot of questions.
Yeah, so if you don't want to be in SpaceX, you might not be able to be an index investor. If you're not using IVV, or if the fund you're in is using a broad index that gets included. But this is where you pull that string and it kind of jumped the desk into this ethical. And I know this isn't the questioner wasn't, I'm ethically opposed to this company. This is overvalued.
Yeah.
There's probably 50 or more other companies that are overvalued on the index that you own anyway. So you've got to go back to, what's your investment philosophy? Am I an index investor? What's my allocation to Australia, the US? On the ethical investing side, we go to our screening. Well, the more ethical you are, the less options you've got. You'll end up investing in cash, which is not an investment. So I'm not kept up at night if I know that, well, if I read and see everyone saying that SpaceX is overvalued, I'm probably not kept up at night if it was inserted into an index that I own.
0.6%.
Yeah.
It's a really good point. I think what is, to your point about how much overvaluation is in there, we have known that it was the Mag 7 for a couple of years there. That's what we were talking about, the hyperscalers. These guys are the absolute top end of the market. Your Microsoft, Amazon's, Alphabet, NVIDIA. Are growing at just extraordinary rates, but the CapEx burn is insane, and the amount of money they're plowing into data centers is wild, and into their AI build-out is wild, and they're restarting nuclear power plants on 3 Mile Island. It's an extraordinary time, and we have seen the top 10 companies in the US at like 40+% of the S&P 500. Those levels of concentration are sort of 99, 2000 levels. But if you chose not to play, you've had a really rough 6 months. And this is the difficulty. You can see that and read that every day of the week, and it makes you anxious, and you go, I don't want to be in that because that will have to come back to earth at some point.
Yeah.
But you've missed a beautiful run.
Well, let's have a look at that now. Anyway, there are kind of our thoughts on SpaceX. I mean, I wasn't running out trying to get subscribed to it. Yeah. I'm very cautious because I've done IPOs myself, and I've called them smash and grabs.
Yes.
It'll be interesting to see what happens over the next 12 months.
Yes,
anyone who can tell you what's going to happen, you can't listen to them.
Yeah.
We know there's 3 things that will happen. I know this much. It'll keep going to the moon. It'll be the best story ever. It'll be flat forever, or it'll be a dog. I mean, they're our options.
Or it's very choppy.
Yeah. Or a combination of each.
Yeah. It could be all 3 of those things in the space of 12 months.
But it goes back to, what is your investment philosophy? If I hold individual shares, I only do 10% of my portfolio value.
Yeah.
And I only do domiciled in Australia because I don't like I don't want to do all the tax forms in the US and all that stuff.
Yeah, we have W8 Ben QI status, so you don't have to worry about that if you want.
Oh, look out.
Yeah,
She's trying to sell me nabtrade. All right, let's get into this economic update. All right, let's get into the market update right now.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au, and they'll point you in the right direction.
Okay, let's do it. So I do this presentation every month / couple of months for the ASX with a presentation they do called CEO Connect, which is kind of cool if you are into individual stocks and genuinely wanting to understand the underlying companies. The CEO will do a presentation, 10-15 minutes, for retail investors, kind of an update on what the company is doing, and I do the market update at the beginning. And the reason it's fun is even when you are watching the market every day, it is really easy to lose context, like what has actually happened over time. And I'm doing it all the time, and I'm still like, oh, really? That is, that's a much more aggressive move than I thought it was, or actually that's pretty flat and boring. So we'll talk about all of those things, and it hopefully will give people a little bit of context on why their portfolio is performing the way it is, whether it's a direct portfolio or it's a passive one. So we, as I said, have more and more passive investors. I used to be, when I gave this presentation, always saying to people, look, this is not your portfolio. This is just the market. Now I'm like, oh, no, this is actually a portfolio because you've only got ETFs.
Yeah.
So it's interesting how many people have had just
But most people
experience.
would have a huge home bias with their ETF investing, which is not a bad thing. It's just a thing.
ASX 200 is the first thing people buy.
Yeah.
And then they build up a really decent allocation to it before they go offshore.
Actually, before you go on, the Quick Start Guide to Investing, my investing book, the first page paragraph basically says, investing is easy. I'll show you how. You could download an investment app, open the account, transfer some money over and buy the ETF IOZ, and voila, you now own 200 of the top companies in Australia. Done.
Yeah.
That's the Quick
So
Start
people
Guide to
have obviously
Investing.
read that.
But it's not a bad thing.
No, it's wonderful. I think it's amazing, right?
But then we need to learn about our diversification. Anyway.
Yeah, but it's such a great start, right? So many people have this. So let's have a look at the ASX.
Yep.
This is the ASX 200, and I pulled it last night, so it's pretty close to being accurate. Few things to note. So it's not an amazing return over 12 months, right? I'm going to use my little thingy
go
here.
for it.
So, right, honestly, point to point, you are up 5%, but that's point to point. We may all remember in April last year, we had Liberation Day.
What a day.
What a day. It was exciting times. Trump unveiled all of the tariffs that were flagged, but way worse than anyone anticipated. Market fell like a stone, but then rallied really hard. And one thing I will also note about our investors and traders is they tend to buy the dip pretty aggressively when that kind of thing happens. So Liberation Day, the day after, when the market was off 7+% at one point, we had our biggest trading day ever, and it was about 95% buying. Yeah, everyone did some shopping. It was great. So many people, when I say this is your return, will have bought the dip here and had a beautiful run up until about October last year. Then we saw a lovely run up until March after a bit of a pullback. We all know what happened then. That was when we kicked off in Iran. Let me do a little circle.
The
this is
excursion, if you will.
Yes, we decided to go and, see what happens when you lob some bombs in the Middle East. Nothing good. Then we come back. Then honestly, the market has recovered remarkably well. So given the amount of what we like to call geopolitical conflict, but very meaningful disruption because that was not just a conflict. We saw, 20% of the world's oil supply locked up in the Strait of Hormuz. We saw a lot of interesting things happen. That's a pretty decent return, right? Between Liberation Day and the Strait of Hormuz being closed, that is not bad.
And to all the people in the Retirite Facebook group who are like, go in and move your super and all that, you can do it. It doesn't cost money or whatever. Well, I hope you manage to buy back in mid-March.
This is what we call a very resilient market, right? And it consistently delivers this resilient performance. A couple of things I will point out. That dividend yield is a little bit low.
4.32 for those not watching on YouTube.
Oh, sorry. If you're not watching, let me...
Yeah, some people drive and listen to podcasts, Gemma.
I'm so sorry. I will use the numbers. 4.32% is the current dividend yield. That is not grossed up for franking, right? That's just the baseline yield. That's a touch low by historical standards. And the reason it's a touch low by historical standards is we have a trailing PE of 19.75%. That is quite high, right? So this is not a cheap market. It is relatively well priced based on historical earnings, so the earnings we've seen so far. There have been some downgrades sort of factored into that. I'll talk about a few of them. But it's not a bad market. I think when you look at the 5-year performance, it's pretty disappointing, like 22% over 5 years. That's cumulative. I'm not talking annual, obviously. That's a bit sad. We all want more than that over 5 years. You know, that's not amazing.
Probably better than cash, though.
Better than cash. That's exactly it. And you've got that yield at the same time. Gross up for franking. It's okay. It's not incredible, but it's still quite expensive. If we have a look, what I love though is you keep hearing everyone go, oh, the markets are very volatile. Gosh, it's volatile. It's a very volatile market. Let's have a look at what happened. So again, I will talk about this. Between July and November, the market basically barely moved in terms of volatility.
Yeah.
We saw, then it dropped to very low volatility in December and January, which is
but that's just
largely
holiday, is it?
seasonal. Yeah, volumes just fall, right?
Yeah.
We saw a spike for obvious reasons in sort of late Feb and March. With the conflict.
Very obvious reasons, yes.
Very obvious reasons. Drop back to, frankly, quite standard. But the next slide, this is what real volatility looks like. The peak of volatility was in 2020, and that was when market prices were moving all over the place during COVID. That was when the market fell 30% in 3 weeks.
Yeah.
That's volatility. What we've seen
So
really...
basically, for those who are driving, there's a diagram from 2016.
It's 10 years. Yeah, that's 10 years.
10 years. There you go.
10 years,
it
last
says
10 years.
over 10 years.
Yeah. Over 10 years.
It's basically squiggly.
Yeah.
Big shot up, COVID,
Yeah.
escalator kind of back down, and then squiggly. So it's very apparent that it was. So, okay, so what I'm learning from this
is when everyone talks about a volatile market.
Volatile and the war stuff in the last 6 months is a kid's birthday party compared to COVID.
Exactly. Nothing even like it. I don't know if you remember. I remember it extremely well because I was trying to play some trades at the time. During COVID, there was a day that the market fell by 8% and closed up 4%. So that is a 12% move in one day. It just happened in both directions. That's volatility.
Yeah.
So we talk about a volatile market. It's not that volatile, is what I'm telling you. And so when people talk about buying the dip now, they're relatively small dips, but people are buying them consistently because the market's not that volatile, right? The market, it's quite resilient, bounces back really quickly. This is the 10-year chart of the ASX 200. I'm describing everything I'm talking about. And it is what you want a chart to be. Bottom left to top right. It's not a straight line because there's a big sharp drop during COVID. There's another sharpish drop in 2022 after everyone realised they'd gotten a bit ahead of themselves post-COVID.
Might get rid of those shares in ARB and Zoom or
whatever. Yeah, all the things I got a bit carried away about. Bit of a pullback with Liberation Day and then a relatively small pullback you can see with the Strait of Hormuz closing.
I need everyone to look at this diagram who gets scared about investing. You own, like it's a roller coaster. And you really only get caught on a roller coaster, caught out, if you're like me in Disneyland last September in Paris where it broke down. But it was a pause.
It was a pause.
For an hour.
Fair enough. And then they got you down?
We're in the dark tunnel about to shoot up on Space Mountain and we're in the dark. Anyway. But if I got off then, which we had to, that was fine. But if you get off when it's in play, that's when the damage happens.
So the only comment I will make
People
about
don't,
that,
Gemma.
because I've been because I've been around for ages, and you have too. The one that hurt people was the GFC.
Yeah.
COVID didn't hurt a lot of people really because it was so short and the market bounced back so quickly. The GFC was a 55% drawdown peak to trough, and it took a year and a half, and it took more than a decade to remake those gains.
But there's no debt in the market in COVID, and there's no debt in what we've been through. You know what I mean? Like the GFC, that was a 25-year, like it was a major event. Global.
Yes, absolutely. It was sort of once in a multi-decade event, right? Those of us who were there at the time are deeply scarred by that experience,
100%.
and we'll talk about it at a different time. That matters if you are just about to retire, that kind of event, but it's rare. And so it hurt people who were just about to retire or who had just retired.
Yeah, but
for the average person, if you were 25, the GFC's in the past now. I was a little bit older than that.
Yeah.
And it's in the past, right? We were lucky we didn't lose everything.
But the GFC, and I say this with a lot of respect to people because I know a lot of people went through it and lost money. The ones that got freaked out when it happened, sold out of their superannuation fund into cash. I literally had so many clients that were sent to me with self-managed super funds, all in cash, for 5 years after 2008.
We also saw that.
And it's just, it's so bad because if they just close their super app and not looked at it,
Yeah.
I get it. It's tough, but anyway.
That's the one anomalous period,
Yeah.
but worth noting that it's in the rearview mirror to the point of nearly 20 years now.
Yeah,
you know,
wow.
it's been a long time.
That old.
Yeah, I know, it's scary. So let's have a look at the S&P 500 because that is where so much of the appetite is. And as I said with our investors, it's ASX 200, daylight, S&P 500, daylight, smattering of other things.
And these are just the share price charts.
This
not
is
the
just the
accumulation.
price chart. Yes, thank you. So there's no dividends in this. There's no income. It's not reinvesting your income, you know, whatever that might be in terms of there's a lot of buybacks in the US. Yeah. It's not so much any kind of return of capital to shareholders. Bottom left to top right, but not as obvious, but worth noting that you've got pretty decent returns, right, over the last 12 months. If you've been in the S&P 500, even with that drawdown in March, it is a much nicer return than if you're on the ASX.
But it's fascinating because Nick, who I wrote this investment book with, he's American, now living in Spain.
Right.
Fired, retired early,
Oh,
financial independence, retire early,
there
all
you
that. He's like Australia's a dual sector ETF,
Yeah.
banks and holes.
Yes. Yeah, absolutely. It's what we do. We do it really well. So let's have a look at 10 years on the S&P 500.
This is why you invest for the long term,
This is why you invest for a long time. And this is why the US is 70% of global markets because nobody else gets this. So this is bottom left to top right as well. But if you put an overlay on the ASX 200, right, not quite the same. You could kind of see the point at which we stopped growing. COVID is barely visible on this chart. That's the bit that's most amazing. Oh, wait a sec. Let me do my little drawing.
Yes,
that's
please.
COVID.
Yes.
Right? If you had a look at the the ASX 200, it is actually the S&P ASX 200, but it's too long to say in my view.
Yeah.
I'm acknowledging S&P as it relates to the 200, but I just can't keep saying it. COVID is quite material. You can see it. It's quite a big deal. When you look at the S&P 500, the US market, it's barely visible. Their rise out of COVID was much sharper and went much higher. So they had a much bigger pullback in 22, you may recall. That was when everyone realised they were paying far too much for Facebook before it became Meta, and too much for Netflix and too much for many other things. But it's really just an extraordinary run back since then. Liberation Day was there. It was a bit painful for a bit. Bounced out of that. Obviously,
it's so funny because the human nature in me, because like this AI thing, it's so inflated in America.
Yeah.
Like we have not had a big, I mean, you look at that 2020 compared to Liberation Day and the war, like the COVID on the S&P looks similar-ish to Liberation.
Yep.
I'm like, is there a big event like at what point does this like? I thought the war would have done it.
Yeah.
I mean, it's not over till it's over.
Yeah. Yes. Till you've given hundreds of billions of dollars to Iran. Yep.
Yeah. Like, I don't know. I just see. This is why for me, I'm a terrible investor.
Yep.
Because my natural proclivity is not glass half empty. It's not half glass full. It's smashed glass. Like, so my strategy is a weekly amount into my ETF portfolio with Life Sherpa Invest. Like I literally, I cannot manage my own money.
Yep.
Because I'm crap.
Because you psych yourself out.
Yeah, and
Same.
it's the Dunning-Kruger effect. Like, you've seen the more you get on, it's like, oh, the more I'm crap at everything and all that stuff. But then what I do is so that's a weekly investment for me. I'm always cash heavy in my life. I don't love running on the line. Always got opportunity funds. When Liberation Day happens, because I do follow markets out of personal interest.
Yes.
Oh, Liberation Day, what? That stock's down 7%.
Yes.
Yoink.
Happy days. Yeah.
Like that's kind of, but again, it's not going to be more than 10% of my portfolio that I quote unquote play with. But then I take money off the table and put it into the portfolio.
Yeah. So we've seen an enormous run up in cash over the last few years. Enormous. It's worth noting when cash is paying better part of 4.5%, that's not a terrible decision for a lot of investors, particularly retirees. That makes sense. They don't have to be exposed to market volatility just to get an income. And that was what we were seeing. A lot of people just having to move into equities and other asset classes just to get an income when rates were at zero. So a higher cash allocation now does make sense because of rates. But there's clearly a lot of people who are waiting for a pullback and it's not happening. But they are disappointed.
Yeah, and that's why I've just resolved literally weekly or monthly investing with my new money.
Yeah. You can't wait for a GFC. Like you cannot wait for that kind of sell-off. It's not happening for you. And also you have to be terribly quick. As I said with COVID, it was a 3-week pull down to 30%.
Yeah.
And then it just
and all
started
these people
rallying
going,
again.
I'm going to sell down out of my super fund and change investment options. Good luck with the timing
You've
that you
gotta
can't
be
control.
Quick. Like
good luck.
Most of our guys are very good at going, that's a drawdown I want to participate in, but you do not have time to wait. Like you really have to be ready to move.
Okay, what else have you got for us?
I have my beautiful heat map and I love a heat map. They're so useful visually. Sorry
if you're driving, sucked in.
Sorry if you're listening. Yeah.
Well, we'll talk about the heat map right after this. Okay. I think we had a heat map in this book actually, but it doesn't really work in black and white.
They're just great if you want to understand what's going on in your portfolio.
Yeah.
Right? Like
so
if you
talk us
want
through this
a
one.
really quick snapshot of what's going on. A lot of people use it for daily. This is a 1-year heat map, right? So this is what's happened over a year. And they are beautifully, here we go. So each big white box is a sector. Each smaller box is a company. And the colours are exactly what you would expect them to be. Green is good, red is bad. So here is what's happening. This is financials, the big box, and on the left-hand side. And financials, the biggest one, which is red, is CBA. Over 12 months, CBA is actually underwater, which is a surprise to many people because it had a hell of a run into 12 months ago and then it's...
But everyone's been, like everyone who knows, has been saying it's been overpriced.
It's the most expensive bank in the world.
Yeah.
All that stuff. Overpriced. However, dangerous game selling it, to your point about timing the market, because every time you sell CBA, it runs 20%, drives him up. So CBA underwater, financials basically dead flat over 12 months. The one that's absolutely beautiful is the right-hand side, which is in the second biggest box, all green. That's materials. So that is your BHP, your Rio, your Fortescue, your Pilbara Minerals, PLS now. There's only 2 red boxes in that one, and it is up nearly 60% over 12 months. Now, what I love about doing this particular preso is 12 months ago, you could switch those colours and numbers. Financials were up nearly 60% year on year. Materials, I think, were down over 12 months at that point in time. So there's just been a complete flip in what's driving the ASX. And it is so neat. But to your co-author's point, we're good at a couple of things. They are mostly banks and materials.
And
But we also
and
have
giving away gas, apparently.
Yeah, we would like the gas majors to not pay us. So we're just happy for them to make some money and enjoy their life. Anyway, consumer discretionary underwater, but very mixed. You can see from the different colours in that box. Energy, small, to your point about giving away gas. Energy is small but very, very green, which you would anticipate after an energy shock of the magnitude we have seen. And then a few other ones we'll talk about. So heat map, great way to see what is going on in the market and what has happened. And you can cut it by time frame, right? So this is a 12-month heat map of the ASX. And I'm just going to break down the 4 sectors that our guys have the most exposure to, but also have been most active in over the last 12 months. Financials, chart plus numbers, so I will talk through the numbers for those of you who can't see the chart, but super choppy and basically sideways. Over 1 year, you're pretty flat, 0.17%. Year to date, negative 0.06 as of last night. Like that's pretty funny. So financials, the one bit that is encouraging, I think, for those who are holding banks is the yield is still really decent. You're basically 5% for your banks. That is definitely not peak yield for the banks. You can gross up by franking, by the way. These are not including franking.
It's funny that the div yield of just the financials is very similar to the market.
Wait till you see the others. But yes, absolutely.
Scary.
The thing that should bother you a bit is you've got a trailing PE of nearly 20 times. It's 19.4. That is very high for financials. These are mostly domestic banks, right? They should not be growing dramatically more than other sectors with higher growth potential. I mean, you're really lending and taking deposits. It's a pretty straightforward business model. There are some areas that the banks can grow really fast. You know, all of them are trying to get exposure to ultra high net worth clients and looking at wealth again, which is interesting.
Yeah.
But these are not high growth companies, right? They are mature companies in a constrained market. That PE is pretty high. It used to be closer to 16. So these are not cheap. You haven't had great performance over the last 12 months, but you've got a really nice dividend yield. The long-term performance, let's look at 10 years, 62% over 10 years. The 5-year performance is pretty rubbish, 38%. But again, higher than the ASX.
So when you say pretty rubbish, what would you expect? Like in your kind of world?
Oh, I think my point is more if I went back 12 months, it was closer to 60% over 5 years. Yeah. So I think I'm pointing out more that it's flattened out very quickly. But again, for quite an expensive banking sector, it's not just banks, but it's mostly banks. So if we flick to the next one, materials is the one where they've just gone to town, right? It's been absolutely incredible. Part of the thesis for this is that in a world where you have pretty sticky inflation, lots of geopolitical risk, a tapped-out consumer, what is going to work for you, and probably a higher rate environment, commodities, you sort of want to own hard assets in that environment. So that's the thesis. Not saying
so
it's
what are some
necessarily
examples of companies in the materials sector?
So BHP's the big guy in the room. You've got Rio, you've got Fortescue. So they're your iron ore miners. But BHP, it's mostly copper now. Not mostly. Sorry. Allow me to correct myself.
Yeah.
BHP's making a ton of money out of copper. And we know that copper is absolutely critical for building out your data centers.
Yes.
And so the electrification story is helping BHP in a big way. Iron ore, there's a
Good
lot
way
of...
to greenwash as well, I guess.
Yeah, happy days.
Let's go, baby.
We burned a lot of things, but we dug out the things to stop burning things. PLS is in there, so the lithium miners are in there. They were very hot a few years ago. They're not quite so hot anymore, but PLS has had an unbelievable run from sort of sub $1 up to more than $6 relatively recently, come back a tiny bit. So your miners are in here, and there's a whole variety of them. You've got Linus if you're interested in rare earths. There's a whole lot of things. A lot of our sort of longer term investors are very, very astute about commodities and miners. That's their thing. They love them. Gold miners are in this. They understand the sector. They understand their particular niche of knowledge and their expertise, and they're very comfortable playing in this space. Those of us who are not super astute about this, and I include myself, right? Have not spent much time in the mines, if I'm completely frank. it's a sector. You know what the major drivers are, and you just get some exposure.
Yeah, love it.
But we have plenty of people who will play stocks in this space because they know the companies really well.
Yeah.
10-year performance, nearly 230%. Go back 12 months, you can change that number quite dramatically, take off 100 or 200% from that. This sort of most recent run has been incredible. So the performance has been super strong recently.
Yeah, all this crap just speaks to diversification in your portfolio.
Doesn't it just?
Yeah.
Partly, and I probably should do it sometime, is do side-by-sides of this is when I did this a year ago and this is when I do it now. And watch it flip-flop from one sector to another. The
you can even
rotations.
overlay them on the same.
I'm not great at my charts, but I'll try. The rotations are incredible. Worth noting, though.
I pay big money to get you here, Jam. I want
Sorry
good
for my
charts.
rubbish charts. You can pull all these charts yourself, by the way.
Yeah,
These are
that's
in
right.
your platform. Like you
all
can just go
public
look at them. This is
information.
all in the public domain, this stuff. 21 times, not cheap. Again, not cheap. Dividend yield of 4%, though, that's not bad. The yield out of the resources sector and out of materials blows my mind because they were just doing massive special dividends a few years ago. The yield on materials was just as high as the banks, if not higher. That's not supposed to happen if you've been around for a long time. These are capital-intensive businesses. They are not supposed to pay you huge amounts of cash. You have leverage to the commodity price, not to their profits in terms of dividends. And yet, here we are. They've been a great sector for dividends, and a lot of our investors have loved it. Energy, this is hilarious to me. Again, for a flip-floppy sector, the long-term performance of the energy sector has been pretty rubbish. 12 months ago when I pulled this chart and specifically this slide, a lot of our investors had been moving into Woodside, and they had been moving into Woodside for a long time. They just felt like it had to move at some point. It had to come back. The year-to-date, 1 year, 5 year and 10-year numbers were all negative for the energy sector as of 12, 18 months ago. And even on this slide, the dividend yield for the energy sector is higher than the PE.
Yeah,
that is not
wild.
supposed to happen.
So for those driving, the dividend yield on the energy sector, 6.3 and the PE, 6.28.
Yeah. Trailing. So this is not analysts' expectations for future earnings. This is just what companies have earned. The sector is up 17% year to date. It obviously spiked massively back in late Feb, March, given what was going on.
And you can see it, tapering back down now.
And then it's really sharply pulled back, and oil prices have pulled back really sharply as well. 5-year numbers, really rubbish.
The 10-year cumulative, 24%.
Yeah.
It's like, what are we doing here?
Yeah, it's nothing to get excited about. But a lot of
the juicy yield.
Yeah. Oh, at one point the yield was over 12%. From the energy sector, which is astonishing. And then I've got one more just because this has been so acutely painful / interesting for our investors. It's just been astonishing. So this is the healthcare sector. Healthcare is dominated by CSL, Cochlear, ResMed. There's not a huge number of large healthcare companies in Australia. Those three companies in particular were where a lot of people looked for their growth because they had international potential and then international exposure.
Yeah.
And then they got absolutely hammered. ResMed got hammered first because of GLP-1s. Everyone's going to lose a ton of weight because they're taking Ozempic, and they are not going to need a CPAP machine, basically. That was the thesis, and so ResMed got smashed. It came back pretty strongly after that. We have since seen, though, CSL, so this is Australia's flagship Commonwealth Serum Laboratories. It's been around a terribly long time. It, in our investor base, was really interesting, right? We only had a very small number of investors in CSL, but they had held it for 20 years, from like $10 up to $300.
Gosh.
So it was your 10-bagger / 30-bagger. People did super well out of it, and they would not sell that thing. They loved it. But we didn't have a lot of people buying it because they felt it was super expensive. It was on a PE of like 60 times. It was the growth story. Cochlear was not dissimilar, but it just wasn't as expensive. Cochlear then ran to more than $300. CSL got absolutely destroyed last reporting season. So August 2025, it fell from sort of plus $300 down into the sort of,
Yeah, so in bringing
talk about the numbers.
Yeah, let's year to date, negative 28 for healthcare. That's savage.
Well, it's savage, particularly when you put it in the context of a massive drawdown in reporting season as well. So CSL got smashed in August last year and then continued to get smashed.
So the 1 year to date is neg 41.
Neg 41. And then if you look at the 5 year, minus 46%. These companies, so then we had Cochlear with multiple downgrades as well.
Jeez.
So when you get the two of them, and so when Cochlear was getting downgraded, CSL just took another leg down and got absolutely smashed again. It's just been really, really painful. What is incredible about it though is even after that, multiple downgrades, absolutely smashed, still only on a yield of 3%, which when you compare it to the banks and the materials and the energy sector is really low. And they're still on a trailing PE of 28 times. So these are not cheap companies yet. They're just cheap compared to their previous prices. And you have to ask whether they will return to an earnings upgrade cycle, whether they can get back on their feet, and whether you will start to see the upgrades that make it worth looking. Well, we're just going to see a re-rating in that PE, basically.
Well,
sorry,
fascinating.
Brandon. It's a depressing one to end on.
Yeah.
Sorry about that. Should have swapped it. Should have swapped it with something else.
Anyway, well, there you have it. We might leave it there.
Yeah.
Because I think that was all, wasn't it? Yeah.
Yeah, that's all I got.
That 20-minute economic update we're going to jump on for. Time flies. So we better,
Sorry about that. Took ages.
I said to the team, oh, we'll do this. Anyway, you can hear Gemma on Your Wealth, the podcast.
You can hear Glen on Your Wealth.
Yeah, you can hear me on Your Wealth. We're actually going to run this episode on Retire Right and Money.
Oh, happy days.
Gemma will also do some Retire Right episodes with us. And thank you so much for watching and listening, everyone. If you found this useful, can you please share it with a friend or family member? It really helps with what we're doing here. Thank you so much, Gemma.
Thank you.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.